Yes, Subash, you can start.
Yeah. You're starting, Harish?
So Aisha, it's 11 o'clock. Should we start?
Yeah, you can start.
Okay, great. Good morning, guys. Welcome all. And since budget is nearing, we thought like we'll have this presentation for you, like wherein we will help you hedge your portfolios as against any potential downside, which may or may not happen. But then like we thought like we should do a small this thing webinar with regards to how do you hedge your portfolio against any potential downside that may or may not occur. So that's the reason like we thought like yeah we'll have this webinar. So I have with me Subash as well. So we both will try to help you in terms of like hedging your portfolio. As I said, any like downfall, potential downfall. So against that, how do you protect your portfolio? Because guys, you know that markets at current levels, like you never know with the scenario or with budget around. So this webinar will probably help you. How do you hedge your portfolio against any potential downside? Subash?
Yeah, hi, Harish, and good morning to everyone. So we can start with the presentation.
Okay. So basically, I'll just try to cover what are like basics of derivatives, and then probably we'll have the strategies. We'll in this webinar, basically we'll be covering probably 3 or 4 strategies which you can use to like use against any like downfall. So these strategies will literally help you hedge your positions against any potential downfall. Okay. So first of all, what are derivatives? Basically, why people trade in derivatives, or what are derivatives? It is basically a financial instrument whose value is derived from an underlying asset. So in case if you have a stock in your portfolio, you can definitely hedge your portfolio with options. Basically, the only thing is it's ideal that you hedge your portfolio with the same stock, and you need to have same number of quantity. Okay, what I mean by that is, suppose if you have say 1,000 quantity of Reliance in your portfolio, and Reliance ka lot size is say 500, then you need to have 2 lots of options. That is what then it would be a perfect hedge, right? So what is derivatives? Derivatives is a financial instrument whose value is derived from an underlying. Those could be equity, forex, commodity, or it can be exchange traded or over the counter. Derivatives are in the form of forwards, futures, swaps, and swaps. We generally trade in futures and options, so we will not cover forwards and swaps because futures and options are standardized contracts, and that those are backed by exchange, right? As I said, those are standardized contract, and it offers high leverage and hedging possibilities. So this is the reason why we are here. We will guide you how to hedge your portfolios, right? And what are the advantages of trading in derivatives? With derivatives, guys, you can take a 3-dimensional position. Basically, you can, like, in case if you have a bullish position, you can buy futures or you can buy options. In case if you have a bearish view, then you can short futures, whereas in equity you cannot do that, right? In case if suppose the markets are supposed to go up and you feel that go down, and you feel that probably in a day, in probably 3, 4, 5 days, the markets are going to come down, you cannot short sell equity, because it's just an intraday product, so you will have to square off your positions intraday. But then in futures you can carry forward the position for 3 months. Contracts are always available for trading, so you can literally take a bearish position as well. And in case if you feel that the markets are going to remain sideways, then you can trade in options by selling options, right? So depending on your view, you can take a position, and that's the specific reason why people trade in derivatives or futures or options, right? So here we go. In case if a trader feels that the markets are likely to come down, he can create a short position. Whereas if a trader feels that the markets may go up, one can create long position. So depending on your view, he can create a long or a short position. And if the trader feels that the markets will remain sideways, then as I said, you can create a short positions in options. There is just one thing: in order to create short positions in options, you need margins. You cannot just pay premiums and take a short position. So you need margins, right? And margins vary from stock to stock, from index to index. So different stocks will command different margins, and the margins vary from anywhere, say 15%, and it goes to 100% as well. So for a nifty stock, like for a generally nifty 50 stock, the margins are anywhere between 15 to 20%, right? But as I said, it varies from stock to stock. Plus, it totally depends on the volatility. Basically, this is what the general scenario is. Higher the volatility, higher the margin, and lesser the volatility, lesser the margin. So that's what the general fund of the markets are, right?
Now, derivatives is a great hedging and risk management tool. It helps to transfer the risk on your portfolio, and there are various instruments that are available in the derivative market, like futures and options. These are the two main tools that are used to manage your risk. So we will be looking at 4 strategies in this presentation. The first one would be hedging your portfolio by using index puts. So suppose an investor has a portfolio of 50 lakhs and he feels that the market, he is bullish on the market for the long term, but in the short term he feels that there could be a correction due to global events or some uncertain events like elections or budget. So we have put an example here. If the Nifty is trading at 14,500, one can buy a 14,500 put, which is trading at 150 rupees. And if the portfolio size is 50 lakhs, then he would need to buy 14,500 into 75, which is a lot size of the Nifty put option, and multiplied into 5. 5 is the number of contracts. So by buying 5 contracts of the Nifty put option, he would be able to hedge a portfolio of around 50 lakhs. This way, if the market falls down, the losses that you incur on your portfolio will be offset by the profits that you make on the put options. So put options, as you all know, increase in value whenever the underlying instrument falls in value. Now, Harish, could you explain the covered call strategy, which is another way of hedging your portfolio?
Sure. So guys, this is again a strategy which generally runs in the market. This is called a covered call strategy. Basically, the view on the market is range bound or mildly bearish, right? So in this strategy, what you do is you hold the underline and then you go ahead and short a call option, out of the money call option, basically. So I'll just explain you how does it work. Subash, can you see my Excel as well?
No, right now I can't see it.
1 second. Share screen. Give me 1 second, I'll get it sorted. Aisha, can you help me with this? Like, I'm not able to share my screen.
Option?
Yeah, I have that show my screen option. So yeah, can you see now?
Yeah, I can see
Yes,
your
yes.
Excel now.
Great. Okay. Now, what is a covered call strategy? Basically, suppose if you have, say, Okay, so Reliance, the current market price is say 2000. Okay, and the lot size of Reliance is say 500. Okay, so what you do is you hold the stock or a future in your portfolio, and then you go ahead and probably short a 2200 ka call option. So you will short a call option. And when you short a call, you get a premium of say 30 rupees, right? So this is called a covered call strategy, where you hold the underlying in your portfolio and you go ahead and short a call option of probably 2200. So what may happen is three scenario may happen. Either the stock may come down, or the stock may go up, or stock may stay at current level. Now I'll just give you an example by example. How does it work? And what are your break-even points, guys? Just one important point to be kept in the mind while doing this strategy is you should have some levels in your mind that at that particular level I will forego my delivery. That's the only glitch in this strategy. What I mean by that is you should be mentally prepared in case if you are taking a 2200 call short. Okay, then you should be mentally prepared on your like upper break even would be 2230. So above 2230 you are mentally prepared, you will forego your delivery. That's the only thing. And in case if you have this thing in mind that yeah, at certain levels 10%, 15%, whatever, you can decide start of the month, and accordingly you can take a position. So in case if you if you are mentally prepared that probably at 2200 or 2230 is your break even, so at 2200 you are ready to forego the delivery, then trust me, this is a superb strategy which will keep like earning for you month after month. Because so as I said, three things may happen. Either the stock may go up, may come down, or stay at current levels. I'll just give you an example. In case if the stock goes up and from 2000 the stock comes to say 2190, then what will happen? What would be your profit? Your profit would be 2000 and 2190. That means your stock equity has risen by 190 points, right? So 190 would be your profit. And because the stock has expired below your selling price, that is 2200, this will become worthless. So this 30 rupees will also become zero, right? And your net profit would be 190 plus 30 rupees. That would be your profit. So 220 rupees is what you will earn. Had you not done this strategy, you would have earned 190 rupees, but because you have done a covered call strategy and the stock has expired below your strike price, you will earn 220, right? So this is the first month. Second month, again, what happens? You start the month with say 2200. Now this time what will happen? The stock will start at say 2200. So what you will do? You will go ahead and probably again you will decide that this month the stock will probably not reach till 2400. So you go ahead and short a call of 2400. So the idea is always stay away from the market, probably 10% on or 12% as well. Generally, just I'll give you a data. Generally, Nifty 50 stocks or Nifty 30 stocks in a month, they don't like they are not that volatile, so they move anywhere between say 5 or 7% or max probably 10%. So to give you an idea, what you can do is probably you can do probably 10 or 12% higher strike. You keep doing covered call strategy month after month, and as I showed you, you can like earn this 30 rupees or whatever the premium is depending on your strike price. You can earn that little bit extra on your portfolio. So this is one scenario where the stock has expired at 2190. In case if the stock goes to about 2230, then yes, then you'll have to forego your delivery. That's the only thing. But yet, in case, I'll show you point wise this thing. 1 second. So yeah, suppose if stock expires at 2250, then what will happen? You will gain 250 rupees in your this thing portfolio, because your stock has risen by 250 rupees or points, but your break even is 2230, right? So 30 rupees is what still you will earn. So the maximum profit in the strategy would be 280 rupees. So about 280 rupees, you will not earn anything. You will have to forego your delivery at 2230 levels, right? This is the only thing. So in case if you are mentally prepared or you are able to decide the levels, trust me, this is a superb strategy to do month after month. Two advantages: you keep earning that little bit extra on the portfolio, one, and you are liable for corporate action as well, because you are not, well, like, the delivery is not gone anywhere. The delivery would be in your portfolio. Two, and third thing, trading with HDFC, guys, the biggest part is we are not charging any interest when you do when you pledge your shares, and you trade against the limit which is generated. So that's the biggest thing, because other brokers are charging anywhere between 18 to 24% interest when you pledge your portfolio and you trade against the limits. But we at HDFC, we are not charging a single penny, or we are not charging any interest when you pledge your portfolios. And so ideally you don't need actual cash. You just have the portfolio, you pledge those shares, limit is generated. With that limit, you can literally do a covered call strategy. So one is this. Secondly, suppose if the stock expires, you have taken this position when the stock was at 2000, and you take 2200 ka call short at 30 rupees. Now second scenario is, suppose if the stock expires exactly at 2000. So on probably 15th, you feel that the stock is not moving that much, so I'll do this strategy. So you sell a 2200 call option, right? 2200 call option when the stock was at 2000. Now suppose on 20th the stock goes to 2020 or 2010, the stock goes to 1980, and on the expiry day again the stock expires exactly at 2000. Then what will happen? You will not gain anything on this portfolio or equity. However, still you will earn this 30 rupees. Why? Because the stock has expired below your selling level and below your strike price. So this 30 rupees you will own. So in spite of you not earning anything on your portfolio, still you will earn that 30 rupees because the stock has expired below your selling strike price, right? So this is the second scenario. Third scenario, suppose if the stock comes to say 1900, then what will happen? See guys, in case if you don't do this strategy, as it is, you're a long-term investor, you have the stock in your portfolio, you will just like watch the stock coming down, and probably you will feel bad, obviously, that the stock has fallen by 100 rupees. Yes, I have incurred a loss in my portfolio. However, in case, so what will happen? So this is just a naked, but in case if you have sold a 30 rupees ka strike, 20, like if you have sold 2200 ka strike price call by gaining 30 rupees, at least your break even or your cost will come down by 30 rupees. So what will happen? You will make a loss of 100 rupees in your portfolio. However, this 30 rupees you will make, so there will be loss of 70 rupees, right? So had you not done anything on your portfolio, as it is, you are incurring a loss of 100 rupees. So in order to curtail that loss, so trust me guys, probably 3, 4 or 5 months you keep doing this strategy, or probably say 6 months if you do this strategy, and you keep earning this 30 rupees, and you have like around say 6 months have passed, okay? So, and the stock has come down by 100 rupees. So you can see over here, in 6 months you would have already earned 180 rupees when the stock is down by 100 rupees. So your portfolio loss is 100 rupees. However, still you have already earned this 180 rupees. So net still you are in profit by 80 rupees. So this is what a covered call strategy is. The only and only thing is, you should be mentally prepared that I am ready to forego my delivery at certain levels. In case if you are able to do that, trust me, this is a super strategy which can earn that little bit extra on your portfolio. So here you are, view on the market, range bound or mildly bearish. Hold the stock and sell a call. I just showed you. An investor holds the stock and of the view that the stock may rise in near future, or the stock will be range bound. So for range bound strategy, this is a superb strategy. This strategy will keep earning you little bit extra on the portfolio. What is the strategy implementation? Call options are sold. The number of call options should be determined by the investor market view and the size of the stock he holds. Guys, again, this is very important. You need to have equal number of stocks in your portfolio. It shouldn't happen that probably you have 500 quantity of Reliance in your portfolio and the lot size is 1000. Then it would be an under hedge, right? So it should, the quantity should always match as against the option, right? Upside potential limited by selling cost. The investor is writing off the potential profit of the stock position. This is what I said. You should be mentally prepared that at certain levels I'm ready to forego my delivery. One, in case if you don't want to forego, then you have an option. You square off your call option and you shift your call option. So suppose if the stock rises due to whatever levels, say due to whatever reasons, the stock rises from 2000 to 2200, you have sold a call at 30 rupees. So this strike price, when you had sold this, the current market price was at 2000, right? Now suppose if the stock goes to 2200, so this call premium will probably become 50 or 60 rupees. So you have an option, you square off this call option and probably you shift your strike prices. That means you sell probably 2300 ka call. So this is how, this is called shifting of strike prices. So you can shift your strike price from 2200 to 2300, and this time when you sell, so this would be a loss, probably you square off at 50 rupees, so you book a loss of say 20 rupees. Okay, so you book a loss of 20 rupees, but what you do, the stock has already risen by 200 rupees. Your portfolio has appreciated by 200 rupees, but yet you feel that probably it's not going to go about 2200 or probably max 2250. So you will go ahead and short probably 2300 ka call and you get a premium of say 20 rupees. Okay, and this time you go right and the stock expires anywhere between say 2280 or whatever levels. Okay, so from 22 to 2280, the stock has appreciated by 80 rupees. So you will still make this 80 rupees, and this loss you will cover by selling this 2300 ka call, and you will make a profit of this 20 rupees. So what will happen? Actually, you have covered your loss of 20 rupees as well, and your portfolio has risen by 280 rupees or points. So this is how basically you can shift your strike price as well. I keep getting questions whether I can square off the covered call strategy anytime. Yes, you can square it off whenever you want. Suppose you take a position now and within 5 minutes you feel that no, I have taken a wrong decision. I have probably I've selected a wrong strike price or something. You can immediately square off the position and you can sell the desired strike price. So this is what a covered call strategy is, guys. This strategy will keep gaining profits for you until the stock doesn't reach that the sold strike price. So this is a strategy, ultimate strategy, which everybody should be doing who want to keep their portfolio for ages and who has that target that at these levels probably I'm going to forego my delivery. So superb strategy for those people. Downside risk similar to that incurred with ordinary stock ownership, right? As I just showed you that in case if the stock falls, as it is, you're not doing anything on your portfolio, but you will earn that little bit extra by selling calls. So by option premium, you're offsetting partially by option premium received. Any opportunity loss in the market rises significantly. That's the only risk that is attached to it. This strategy can be done for clients who wants to keep the stock for ages and does not intend to sell in near future and wants to earn that little bit extra on the portfolio. So that's about covered call, guys. Subash?
Yes.
Yeah, you can do. You want to do protective put, right?
Yeah. Can you see my screen?
1 second, Subash. Yeah, now I can.
Oh. So earlier I talked about protecting a portfolio of stocks. Now in this strategy, we can protect a single stock by buying a put option on that particular stock. So suppose you hold Reliance Industries and you're bullish on the stock for the long term, but in the short term you expect a minor correction, then you can buy put options of Reliance. So this way you continue holding the stock and you make profits in the long run, but in the short term, if it falls, then any losses on the stock are offset by the profits that you make in the put option. So we will look at an example here. This example involves Bharat Electronics. So the trader is holding the stock of Bharat Electronics at 108 is the current market price. He bought it for 100 rupees and he's still bullish on the stock. So as you can see on the table below, as the stock falls down, the profits that you make on the option keep reducing and gradually increase. As it falls to 80 rupees, you are making a profit of almost 17 rupees on the put option, whereas you make a loss of 20 rupees on the underlying stock. So the 20 rupees loss is offset by the profit that you make on the put option, and your net loss is only 3 rupees. So even though the stock fell by more than 20%, your loss is only 3 rupees, which is roughly 3%. So by buying put options, you are able to protect your profits and minimize the losses when there's a temporary fall in the stock. So the upside potential in this strategy is unlimited because you continue holding the stock, and if the price goes up, then you continue to profit from the underlying stock position. Your put option would expire. The only downside in this strategy is that you have to pay a premium for buying the put. So that is the only loss that you suffer, and you continue holding the stock. The break-even point on this strategy is the underlying strike price minus the premium that you paid to buy the option. So in this strategy, you can also protect your futures portfolio. So suppose you're buying Reliance futures instead of Reliance stock, you can also hedge it by buying the put option on Reliance. So it's a flexible strategy. You can use it for protecting your positions in the stocks or in futures. Now, Harish, could you explain the collar strategy?
Yeah, sure. Thank you, Subash. Guys, again, this is very important strategy which we are going to discuss. Okay, this is called a collar strategy. I'll not get into the names of the strategy because at times the name complicates the strategy. So I'll keep it very simple. What exactly it means. Subash, my Excel is visible, right?
Yes, I can see your Excel sheet.
Great, thank you. So suppose, as I said, Reliance current market price is, you hold the stock 500 quantity of Reliance in your portfolio, okay, and current market price is 2000. Now, as Subash said, that you can hedge your portfolio by buying the put option. So one option is that. Second option is, at times people say that I don't want to spend that much on my portfolio because the premium which the strike is commanding is too much. So I don't want to spend that much, but yes, I want to protect it. Like I want to protect the entire downside. However, I want to spend little bit less. That is what a collar strategy is. So this is what we will try to cover. So suppose 2000 with current market price at 2000, strike price of 2000 is commanding a premium of say 50 rupees. Okay, this is premium, put premium. All right. Now suppose 2000 strike price ka put premium is 50 rupees. Okay, so what the strategy says, I'll buy a put option. Okay, I'll write action over here. I'll buy a put option of 2000 strike price. So the moment I buy a put option, that means my entire downside is protected. So from 50 rupees, so lower break even is 1950. That is my lower break even. Below 1950, I will not incur a loss. My losses will stop, right? So this is my break even point on the downside. That is break even point. Okay. So in case if the stock falls to probably say 1900, what will happen? My stock will give a loss of 100 rupees. but I will make a profit of 50 rupees. This 2000 ka premium which I spent 50 rupees will become 100, but I have spent 50 rupees in order to buy this strike price. So this would be 50 rupees would be my profit. So my net loss would be only 50 rupees. So I just show, this is what I mean by 1950 would be the break even. So this is just buying a naked put option, which just Subash explained. So in this collar strategy, you feel that probably the stock is going to fall little bit, right? But I don't want to spend this 50 rupees. This 50 rupees is too much to be spent. So what I do is I include one more strategy wherein probably I sell a call option of probably say 2200, okay? And I get a premium of say 30 rupees. So what will happen? You have protected your portfolio against the entire downside is protected for sure, and your break even from 1950 comes to, so 50/30, so 20 rupees. So 1980 would be your break even. So you can see you have reduced your you have got your break even points up, right? So I'll remove this. So 1980 is your break even. So below 1980, you are absolutely protected. So what will happen? I'll give you an example over here. So suppose you have done this strategy. You bought a put option, you sold call option. Okay. So this is the strategy with current market price at 2000 with lot size of 500. You bought put option by spending 50 rupees and you have sold call option and you got a premium of 30 rupees. So what may happen in case, suppose with budget nearing, you know that during budget time generally markets are very highly volatile, right? So this is a strategy to like go to strategy, you can say. So what will happen again, the stock may either hover around same levels, either it will come down or it will come up, right? It will go up. So in case if the stock falls and it comes to say 1900, what will happen? Your portfolio will depreciate by 100 rupees, 100 points or 100 rupees, right? So you will incur a loss of 100 rupees. However, this put option will become 100, right? But you have spent 50 rupees. So again, profit would be 50 rupees in your option. Option profit would be 50 rupees. And you have sold a call option of 30 rupees as well. So this will become zero, right? So even this would be your profits. So your profit in options would be 80 and your loss would be 100 rupees loss in your equity. So net if you see, just 20 rupees is the net loss, whereas the stock has fallen by 100 rupees. Similarly, in case if the stock falls to say 1800, the stock has lost 200 rupees. That means 200 rupees gone from your portfolio. However, you will only and only incur a loss of 20 rupees. So irrespective of the stock falling to whatever levels, your loss will always be curtailed to just 20 rupees. That's about it. The maximum loss you can incur in this position is 20 rupees. It cannot go beyond that. Okay. So this is what in case if the stock falls on downside. In case if the stock goes up, so what is your upper break even? Your upper break even would be 2020. That is your BEP on the upper side. So the stock trades anywhere between 2220 and 2200, you will make a profit. So suppose if the stock expires exactly at, so day one you do this strategy and last day suppose if the stock expires at 2200, so what will happen? You will still make a profit of 180 rupees. And after that, after 2200, if the stock rises, because you have sold a call option, this will become active. You will not make a profit. So upper break even is 2200. Guys, again, in futures, when you trade, how many of the clients or we make a profit of probably 100 rupees or 50 rupees? No one, right? So this is this is a go-to strategy wherein like you will earn that you will protect the entire downside, and on the upside probably you will make that 20% or 10% depending on which strike you have sold. So this is a go-to strategy, guys. This is called a collar strategy, and I would advise, suggest, request everybody with budget nearing, you can you can have a look on this strategy. You can buy at the money calls, at the money puts against the portfolio, and the desired levels which you feel that this is the level which is not going to come in this month, that is the strike price which you can select, and you can go ahead and short a call option. So you short a call option in order to bring down the cost of the premium which you have bought. So this is a go-to strategy, guys. I would advise, my sincere request would be do this strategy. You can go ahead and have a look on this strategy with budget nearing, because the volatility definitely is going to increase with the levels at which the markets are standing. I don't know whether the markets are going to come down or come up, but this is the strategy. This is a go-to strategy, right? So conservatively bullish, I just told you the strategy is just conservatively bullish, because about 2200 you will not make anything, because you have sold a call option. Your options which are sold, that will become active. So about 2200, that is your break-even point on the upside, but still you make 180 rupees, which is a decent amount, right? And on the downside you are entirely protected. Upside potential limited, as put options are bought with fixed premium loss, and OTM calls are sold, limited to the premium paid. Break-even point, I just showed you the break-even as well, right? Upper break-even is 2020, down below break-even is 1980. Below 1980 you are totally protected. Note, this strategy can be done to protect the portfolios and can be done to trade in futures. Whoever trade in futures, guys, this is a go-to strategy. Buy future, buy put and sell call option. And in case if your view is negative, you can reverse the position by probably selling a future, buy a call option, and sell a put option. Even that as well you can do, right? So anyway, you can adjust your option positions in collar strategy. Over to you, Subash.
Yeah, just share my screen.
Yeah.
Visible?
1 second. No, Subash. Yeah, now it is.
Okay. Yeah, so we have come to the end of the 4 strategies. So there are certain things that one should do and not do. So first we look at the things that one should do. It is important that you work on official research recommendations and not some rumors. So because the analysts are doing their work, intense research, and coming out with recommendations, so it's important that you take advantage of them. And when you enter into a trade, it's important that you look for a risk to reward ratio of at least 1:2. So if you're risking 100 rupees, then you should look for a reward of 200 rupees. It is important that you keep a stop loss or hedge your positions to control your risk. And it's also important that you be informed of the concept that you're trading. So, and follow it on a consistent basis. And what not to do. Do not work on tips or without any research consultation. Do not take high risk with limited reward. So as I said earlier, you look for a risk to reward ratio of at least 1:2. And do not take more exposure if you are not able to pay the mark-to-market margins. Implement appropriate money management rules. Experts recommend that you don't risk more than 1 to 2% of your capital on each trade. So that way your capital is protected and you can be involved in the markets for the long run. So with that, we come to the end of the presentation. If you have any questions, you can please be free to ask them on this webinar, and we'll be glad to answer them.
while the queue is accumulating, I would like to tell one more thing which I probably forgot. Guys, when you take a hedge position as well, uh, hedge means, suppose if you hedge your portfolio, okay, okay. Now suppose Nifty is trading at say Now suppose Nifty is trading at say 14,500. Okay. In order to trade in one lot of Nifty futures or options, in case if you want to sell, then the margins are approximately, guys, this is approximate figure, approximately 1,20,000. Okay. So this is what a margin is required when you short or a long futures or you short a option. 1,20,000 is the margin. Okay. But suppose the strategy which Subash was suggesting, or probably I was suggesting, you get margin benefits, and the margin benefit is tremendous. Like you get approximately 70% margin reduction. So suppose if you buy a future and probably you buy a put option, then the margins will come down to approximately 22,000 rupees. So approximately, guys, you can see 70% straight away margin reduction or margin benefit is what you get. So two benefits: you are protected downside, like you are protecting yourself the entire downside, plus you are getting a margin benefit of 70%. So guys, like no reason why you shouldn't be hedging your portfolios, right? So this is for the traders who generally trade in this is generally for traders who trade in futures or options or something like that. So you can get margin benefit approximately up to 70% in case if you hedge your portfolios. Yeah, Subash, any question? Any question we have? We can
Yeah,
take
there
the
was a
question.
question about how do we get the break even on the collar strategy. So could
Yeah,
you
sure.
explain that?
Yeah. So the break even is okay. So 2000 is the current market price. This is current market price is CMP. Okay, I'll remove the lot size. You buy a put option. So 50 rupees is what you have spent in order to buy this 2000 strike price. Right. So your this strike price is commanding 50 rupees ka premium 2000. So you've spent 50 rupees. However, you have sold this. So you're buying something and you are selling something. So plus minus when you do, so 50 minus 30 is 20. So that is what you will include in your current market price, that is 2000. So 2000 plus 20, that is your upper break even. So at like above these levels, you will start making profits. And on the downside, 2000 less this 20 rupees. So 50, here you go. I've spent 50 rupees, received 30 rupees. So here you go. In a very simple language, when you bought this strike price, you have spent 50 rupees ka premium in order to buy this strike price, and you have received 30 rupees, right? So this is your 20 rupees is what you have spent in order to buy this strike price. So this is so current market price less whatever you have spent. That is your break-even points. I hope you understand this.
Okay, there was a question, should we sell a straddle on budget day? So my answer to that question is I would not recommend selling a straddle on the budget day, because this is a strategy where you expect the markets to be range bound and quiet. So typically on a budget day, markets are likely to be volatile. So it is better to buy a straddle rather than sell a straddle on the budget day.
Great.
So there was another question. when do we have to apply a stop loss? So Harish, could you answer that?
Yeah. So guys, you can see a collar strategy that doesn't need a stop loss, because as it is, when you're buying a put option and selling a call option, the stop losses are always in place. Or else when you're buying a put option, the moment you buy a put option against your portfolio or against the futures, you are restricting your losses. That's what it is. So as it is, buying an option against the position is a stop loss, you can say.
Okay, there was a question about can you please explain the Nifty hedge? So what I said was a person is holding a portfolio of 50 lakhs, and if he feels that there could be a short-term correction in the market, he can buy the Nifty puts for a similar value and thereby protect his portfolio. So if the 50 lakhs comes down to 45 lakhs, the put options would increase in value and offset that 5 lakh loss which he has made on the cash portfolio. There's another question. What is the margin for the call option?
Okay, for Nifty call option, it's approximately 12 to 50, 12 to 4, between 12 to 14%. But again, exchange periodically reviews margins, so the margin changes from stock to stock depending on the volatility. But for Nifty, if you say yes, it's approximately anywhere between 12 to 14%. In rupee terms, you can say in case if you want to short one Nifty options, you would need approximately 1,20,000 or 1,000 rupees in order to short one lot of Nifty. And as I said, when you take a hedge position, then the margins fall drastically. So in case if you're shorting a straddle, then the margins would be like straddle or a strangle. So basically two different strike prices or two same strike prices. So when you're doing a straddle, that means you're selling same strike prices. In order to sell one lot, you need approximately 1,20,000. So two lots would be 2,40,000. But because you have sold a straddle or a strangle, the margins comes to approximately 1,90,000 or 1,000 rupees. So you get a lot of margin benefit when you do a hedge position. And when you buy an option against a sell position, then the margins falls to approximately like 70%.
Okay, there's another question. A client is holding a portfolio of 70% in large cap, 20% in mid cap, and 10% in the small cap. So how would he hedge this portfolio? So my answer to that is, since the mid cap and small cap tends to be more volatile, you could buy more put options, and that way you can protect your portfolio depending on the beta, because mid cap and small cap have a higher beta, so you could buy a greater quantity of Nifty puts, so that if the market falls, then your Nifty puts will make more money since you have bought more quantity and thereby protect your portfolio.
I would like to add one more thing to just what Subash said. Guys, yes, there was this concept of beta hedging, which fund managers used to do, but probably like you remember, you remember last year or probably this year as well. What happened was out of those Nifty 50 stocks, probably suppose if you had Reliance in your portfolio, practical example would be Reliance ran up by probably 800 or 900 points and Nifty was hovering around same levels. So in case if you like hedged your portfolio against Reliance by buying Nifty options, then you would have incurred probably little bit of a loss in your hedge position. So nowadays the trend is changing. This is what my personal thing is, that the trend is changing and you can hedge your portfolio against that. Stock to stock would be an ideal thing. So what I mean by that is, suppose if you have Reliance in your portfolio, it's ideal that you hedge the position by buying Reliance options. In case you have say TCS in your account or Infosys, it's better you like hedge your positions with TCS by buying TCS options or probably Infosys option. But yes, in case if the stock is not available in Nifty 50 or not available in futures, then yes, you need to calculate the beta and accordingly you can buy Nifty options. Thank you.
Okay, there are no other further questions. So we can close the webinar. Thank you all once again.
Thank you guys for joining, and I hope this webinar would have helped you to trade in a better way, to curtail your losses. And trust me, guys, if you implement this webinar will definitely help you to curtail your losses or to hedge your portfolios against any unforeseen event. And with budget nearing, I would suggest to go ahead and please do these strategies. So thank you guys for joining, and I wish you have a great day ahead. Thank you.
Thank you, everyone.